Today, we'll be exploring the concept of financial leverage and the various financing alternatives available to businesses. Understanding financial leverage is crucial because it helps companies determine how much debt they can responsibly take on to maximize their returns without undue risk. We'll also look at different financing options so you can get a clear picture of how firms can fund their operations and growth. Let's dive into these foundational ideas to set the stage for more detailed discussions ahead. On this slide, we're focusing on the main objectives of the module, which center around understanding financial leverage and different financing alternatives. First, we'll explore how borrowing money can boost your investment returns, but at the same time, it increases your risk. This concept of leverage means that gains or losses can be magnified. Next, we'll compare various financing options, including traditional mortgages, equity participation loans, and seller financing. Each has its own advantages and considerations, and understanding these will help you make informed decisions. Finally, we'll look into key factors like loan-to-value ratios, the cost of debt, and the income generated by the property itself. Evaluating these elements carefully is crucial when deciding how much leverage to use in your investment strategy. Financial leverage is essentially when you use borrowed money to increase the size of your real estate investment beyond what you could afford with just your own cash. This strategy can work really well because it magnifies your returns when the property does well. However, it's important to be cautious because the opposite is true too. If the property doesn't perform as expected, your losses can also be much larger. So, understanding financial leverage is crucial when exploring different financing alternatives in real estate. Here we have a simple example illustrating the concept of financial leverage and the difference between an all-cash purchase and a leveraged purchase. On the left side, you see the all-cash purchase scenario. The property value is $1 million, and the entire amount is paid up front with cash. This means there's no borrowed money, no debt, and the initial equity is the full $1 million. You own the property outright, without any obligation to lenders. Now, contrast that with the leveraged purchase on the right. The property value remains the same at $1 million, but instead of paying it all up front, you only put down $250,000 as a down payment. The remaining $750,000 is borrowed. This means your initial equity is just $250,000, but the borrowed amount allows you to control the entire property with less cash invested. This leverage can magnify your financial outcomes, both potential gains and losses, because you have a smaller cash investment tied up, but you're responsible for debt and its associated risks. This example highlights the trade-offs between financial flexibility and risk exposure when using debt to finance property purchases. Now, let's dive into the leverage equation and how it impacts your return on investment. Leverage, in simple terms, means using borrowed money to enhance your returns. Specifically, leverage can raise your return on equity or ROE when the cost of borrowing is less than the return generated by the property. Think about it this way. If your property is generating an 8% return and your borrowing cost is just 5%, this positive leverage means borrowing actually boosts your overall return. However, if the property return is only 5% while the debt costs you 7%, that's negative leverage. Borrowing in this case would reduce your ROE. Several factors influence this result. The cost of debt, which includes interest rates and loan terms, is critical. Your property's performance matters too, because the income you generate must outpace your financing costs. The amount you borrow also plays a role. Borrowing more with less equity can magnify your returns, but it also increases risk. So, understanding financial leverage means balancing these elements: the cost of the loan, property income, and how much equity you put in to maximize your return without overextending yourself financially. When we talk about the upside of leverage, the key concept is amplified returns. By using borrowed capital, investors can achieve a higher return on their equity, provided the property's income exceeds the cost of the debt. This leverage allows investors to control larger assets without having to pay the full purchase price up front, effectively increasing their buying power. Another important benefit is capital efficiency. By preserving cash, whether for reserves or to invest in additional deals, an investor can enhance overall portfolio growth. Essentially, financial leverage helps stretch your investment dollars further. To illustrate this, Consider the same property purchased with leverage compared to an all-cash purchase. With leverage, you invest less equity but can potentially earn a bigger return on the cash you do invest. If operations remain strong and property income outpaces debt costs, the leveraged ownership produces a steeper return profile over time. Looking at specific numbers, you see that the cash-only return might start at 8% in year one and gradually increase to 11% by year four. Meanwhile, the leverage return starts higher at 12% and grows to 18% by the fourth year. This widening spread demonstrates how leverage magnifies gains when the property's returns exceed the cost of debt, making it a powerful tool for increasing investment performance. When we talk about the downside of leverage, the main concern is the increased risk involved. Even small declines in the value of your investment can cause disproportionately larger losses on your equity. This happens because while the property value may drop, your debt payments remain fixed, meaning you still owe the same amount regardless of market conditions. If the market turns and the asset price falls, the loan balance doesn't change, so you could quickly lose your equity. High leverage leaves very little room for mistakes because a modest decline in asset values can wipe out your entire investment stake. It's crucial to understand how leverage amplifies both gains and losses, especially when market conditions become unfavorable. Here we see the leverage spectrum, which illustrates the relationship between risk and return when it comes to financial leverage and financing options. On one end, you have all cash investments, representing low risk and low return because there's no debt involved. Moving along the spectrum, lower loan-to-value ratios, like 50%, indicate stable income but with some market uncertainty. As leverage increases to around 70% LTV, the risk and return balance out, reflecting typical market conditions. At the higher end, with 80% LTV, there's strong rental income and high confidence, but also more exposure to market fluctuations. Essentially, higher leverage can amplify your potential gains, but also increases your risk. So it's important to carefully consider where you fall on the spectrum when choosing financing strategies. Here, we're looking at conventional mortgages, which are the most common financing option for investment properties. These loans are known for being predictable and familiar, and they largely depend on the borrower's financial strength. One of the main advantages is the fixed interest rate, which means your monthly payments stay steady over time, making it much easier to plan and manage your cash flow. Typically, lenders will expect a down payment of around 20 to 30%, which shows you have meaningful equity in the property. Loan terms usually range from 15 to 30 years, spreading out the payments to align well with the period you intend to hold the investment. However, approval and the specific terms you receive depend heavily on factors like your income, credit score, and available reserves. Conventional mortgages are best suited for borrowers who meet these standard underwriting criteria, offering stable financing with clear, predictable terms. Let's take a closer look at the advantages and disadvantages of conventional mortgages. On the plus side, these loans offer stability with predictable payments, which really helps when it comes to long-term planning and managing cash flow. Competitive rates are another benefit because lenders often keep pricing attractive for qualified borrowers. You also get favorable terms, and standardized loan structures provide clear repayment schedules and reduce transaction complexities. Plus, long amortization periods can lower your monthly payments, making financing more affordable over time. However, there are some downsides to consider. Conventional mortgages typically require a high down payment, which means you need substantial upfront capital before you even get approved. Qualification standards are strict, with lenders looking closely at credit, income, reserves, and documentation, so not everyone will qualify. Finally, there's rate risk. If borrowing costs go up, your returns can shrink and the viability of your project might be affected. Balancing these pros and cons will help you decide if a conventional mortgage is the right financing option for your needs. Now let's talk about equity participation loans, which are an interesting financing alternative. Essentially, the lender agrees to accept a lower initial interest rate in return for a share of the property's cash flow, any appreciation in value, or the proceeds from a future sale. This structure helps reduce early debt costs, which are particularly beneficial for investors who might be tight on cash at the outset. It also creates a strong alignment between the lender and borrower because both parties benefit when the property performs well. However, the trade-off for the borrower is giving up some of the upside profits if the asset performs better than expected. This approach balances risk and reward in a way that can be very appealing in certain investment scenarios. On this slide, we're focusing on equity participation loans and when they're most appropriate. These loans are particularly well suited for properties with strong potential for appreciation and for investors who are comfortable sharing the upside in exchange for certain benefits. Starting with the standard mortgage, it features fixed debt payments, meaning the borrower makes consistent payments over time. The return here is that the owner keeps all the appreciation, but the biggest risk is the higher cash burden since you're making those fixed payments regardless of property performance. Equity participation loans, on the other hand, have lower debt payments but come with a trade-off. You share a portion of the property's appreciation with the lender. This means the upfront cash burden is reduced, but you retain less appreciation as your partner is now sharing in the upside. The risk here shifts to having lower payments, but sharing returns with a financing partner. Lastly, if you go with full ownership and no financing partner, you have no debt obligations, so you keep all the appreciation yourself. However, this also means putting up the most capital and taking on the highest financial risk. Understanding these differences helps you choose the right financing structure based on your appetite for risk, cash flow considerations, and expected property returns. Seller financing is an alternative funding option where the property owner acts as the lender instead of a traditional bank. This means the owner provides part or all of the financing for the purchase. One of the major advantages is the flexibility it offers. Terms like the interest rate, down payment, amortization schedule, and loan maturity can be negotiated to fit the specific needs of the deal. Additionally, seller financing often allows for a faster closing process because there are fewer institutional requirements, which helps reduce delays and simplifies the transaction. Overall, this method is a useful tool for financial leverage and exploring financing alternatives beyond conventional loans. When we look at seller financing, it presents some real opportunities. One key advantage is flexibility. The terms can be tailored directly between buyer and seller, allowing for a custom fit that meets both parties' needs. This direct negotiation also speeds up the process, since fewer institutional hurdles mean transactions can move forward more quickly. Additionally, things like down payment amounts, amortization schedules, or interest structures often have more room for negotiation compared to traditional financing. However, there are some pitfalls to consider. Seller financing often comes with higher interest rates than conventional loans, which can increase overall costs. Terms are typically shorter, which may lead to balloon payments and create refinance pressure down the line. Another important consideration involves due-on-sale clauses that may exist with the original lender, which should be triggered when ownership changes hands. Understanding both the financial leverage seller financing offers and these potential challenges is crucial. It provides an alternative financing path, but one that requires careful evaluation of the terms and risks involved. Let's talk about the loan-to-value ratio, or LTV, which is a key concept in real estate financing. LTV is calculated by dividing the loan amount by the property value, and then multiplying by 100 to get a percentage. Essentially, LTV tells us how much a property's value is financed through debt. A higher LTV means you're borrowing more money relative to the property's value, which also means you have less equity or your own money invested in the deal. For example, if the property is worth $500,000 and you take out a $400,000 loan, your LTV is 80%. That means you put down 20% or $100,000 as a down payment. If you increase your down payment to 30%, say $150,000, your loan amount decreases to $350,000, resulting in a 70% LTV. Similarly, with a 40% down payment of $200,000, your loan decreases to $300,000, making your LTV 60%. Understanding LTV is important because it influences your borrowing costs, risk level, and financing alternatives. The higher the LTV, the greater the financial leverage, but also the greater the risk for both you and the lender. Here we're looking at how loan-to-value ratios, or LTVs, affect lending standards and investor risk. When the LTV is low, around 50 to 60%, this is the safest zone. Lenders offer the lowest interest rates here because borrowers have strong equity positions. which reduces the chance of default. Investors also face the least risk in this range. Moving up to a medium LTV, between 65 and 75%, terms become more standard with moderate rates. This level is seen as balanced by lenders, representing manageable risk for most investors. However, once you get to high LTVs, above 80%, things become much riskier. Lenders tighten their underwriting standards and charge premium rates because investors are dealing with slimmer cash flow margins, increasing the risk of financial strain. As leverage rises, so does caution among lenders and exposure for investors. When we talk about the cost of debt, several key factors influence the interest rates and terms you'll encounter. First, consider the credit score. Borrowers with stronger profiles typically qualify for lower rates and better loan pricing, reflecting their lower risk to lenders. Next, market conditions play a significant role. Base rates, inflation, and how eager lenders are to lend all affect borrowing costs, pushing them up or down depending on the economic environment. The loan term is another crucial factor. The length of amortization, and whether the interest rate is fixed or variable during certain periods, can change the total interest you'll pay over the life of the loan. Then there's the property type. Stable, lower-risk assets often attract more favorable financing terms because they represent less risk to lenders. To illustrate how sensitive the math is to rate changes, let's look at an example. On a $500,000 loan over 30 years, a 5% interest rate results in approximately $25,000 in annual interest. But if that rate shifts to 7%, the annual interest jumps to about $35,000, creating an approximate $10,000 gap each year. This difference can significantly affect your cash flow and tightens your margin for error, highlighting why securing the lowest cost of debt possible is so important when leveraging finance options. Here, we're looking at the concept of debt service coverage ratio, or DSCR, which is crucial when analyzing property income in relation to debt payments. DSCR is calculated by dividing net operating income by debt service payments. If the DSCR is greater than 1.25, it means the property's income comfortably covers the debt. This is the ideal scenario because it gives lenders greater confidence and provides a healthy cushion for investors, making approval more likely. When the DSCR equals 1.0, the property's income exactly matches the debt payments. This situation is riskier because there's no room for error or unexpected expenses. Lenders may be cautious, and approvals can be difficult. Finally, if the DSCR is less than 1.0, it means the property generates insufficient income to cover debt obligations. This usually leads to lender rejection and poses a high risk of default. Understanding these thresholds helps in assessing financial leverage and deciding which financing options make sense for an investment. Now, let's talk about evaluating leverage in practice. The first step is to calculate the capitalization rate, or cap rate, which helps us understand the property's potential return on investment. Next, we determine the cost of debt, meaning the interest rate and terms associated with any borrowing. After that, we compare the returns, weighing the benefits of using leverage against the cost of debt. Then, we assess the cash flow to ensure that the property can cover expenses and debt payments comfortably. Finally, we evaluate the downside risk, considering what could happen if the investment doesn't perform as expected and how leverage might amplify those risks. This process helps us make informed decisions about financial leverage and choosing the best financing alternatives. Here we have a case study focusing on a leverage decision for a multifamily property priced at $2 million with an estimated net operating income of $180,000 per year. The key question is, which capital structure offers the best equity return without taking on excessive risk? First, there's the all-cash purchase option. This requires an equity investment of $2 million, generates an annual cash flow of $180,000, and yields a 9% return on equity. The benefit here is there is no debt risk since you own the property outright. Second, we look at financing with a 60% loan-to-value ratio, meaning you put in $800,000 in equity. The loan carries an interest rate of 6.5%. This option produces an annual cash flow of $86,000 and boosts the return on equity to 10.8%. This moderate leverage enhances returns without pushing risk too far. The third option is to increase leverage to 75% LTV and interest rate of 6.9%. Here, your equity investment drops to $500,000 with annual cash flow at $51,000 and a return on equity of 10.2%. While this higher leverage reduces your equity outlay, it also means a thinner cushion and increased risk. In summary, while the all-cash purchase eliminates debt risk, introducing moderate leverage can improve equity returns significantly. However, pushing leverage too high may diminish your risk margin. The ideal choice balances maximizing return while managing risk thoughtfully. Let's talk about how different market conditions influence financing decisions, especially when it comes to financial leverage. First, rising interest rates typically encourage a more cautious approach. Higher rates increase borrowing costs, so companies tend to favor lower leverage to avoid excessive debt burdens. On the other hand, when the economy is growing robustly, there's often more confidence in future earnings, which can support higher leverage levels. Businesses may feel comfortable taking on more debt to finance expansion or new projects during these times. Lastly, during periods of market uncertainty, the trend swings back toward conservatism. Companies usually prefer to limit their leverage to maintain financial flexibility and reduce risk. So, understanding these market conditions is crucial for making smart financing choices that align with the current economic environment. Leverage should be a powerful tool when used correctly, but it can also lead to significant problems if it goes wrong. The key issue arises when debt starts to outpace income, equity, or financial flexibility. At this point, leverage stops being an advantage and instead magnifies the downside risks. One major area to watch closely is the stress points in your financial structure. There are several red flags to be aware of. Negative cash flow is a critical warning sign, indicating that the property isn't generating enough income to cover expenses. Declining property values can quickly erode your equity, reducing your options to refinance or sell if needed. Interest-only loans might seem attractive due to lower initial payments, but they carry the risk of leaving your principal untouched, meaning you're not actually reducing your debt during that period. Additionally, overextended debt leaves little room for unexpected expenses or financial setbacks. If loan payments exceed the property income, you'll need to cover the shortfall out of pocket, which can strain your finances. Ultimately, too much borrow without proper buffers can leave you vulnerable to vacancies, repairs, interest rate changes, or income fluctuations. Understanding these risks and monitoring these red flags is essential for managing financial leverage effectively and exploring safer financing alternatives. When choosing the right financing strategy, a key factor to consider is your risk tolerance. On one hand, if you have a lower risk tolerance, you might lean towards a conservative approach. This means using lower leverage in conventional debt, aiming for stronger coverage to protect your cash position, especially if your reserves are limited or stability is a top priority. If your risk tolerance is moderate, a balanced approach makes sense. This involves moderate leverage that aligns with stable operating performance, suited for those with adequate reserves and dependable income. It allows for some flexibility while maintaining a reasonable level of safety. For those with a higher risk tolerance, an aggressive approach might be appropriate. This strategy uses higher leverage, but only when potential upside clearly outweighs the risks. It works best if you have strong reserves and can handle income volatility, accepting more swings in cash flow. Ultimately, your choice depends on your cash position, property income stability, and overall risk appetite. Balancing these factors helps determine whether a conservative, balanced, or aggressive financing strategy will best support your financial goals. Here are the key takeaways from Module 12 on financial leverage and financing alternatives. First, leverage amplifies both gains and losses. So while it can increase your returns, it also increases risk. Second, different financing options are suited to different investment situations, so choosing the right one is critical. Third, loan-to-value or LTV and the debt service coverage ratio, DSCR, are essential tools to evaluate the viability and safety of financing. Fourth, the cost of debt should be justified by the potential benefits. Taking on more debt only makes sense if the expected returns outweigh the added risk. Finally, it's important that the property's income and your personal liquidity can comfortably support debt service payments to avoid financial strain. These points are crucial for making informed decisions about leveraging and financing alternatives. Let's wrap up by focusing on a few key takeaways about financial leverage and financing alternatives. First, leverage is a powerful tool, but it must be used wisely. It's not about taking on as much debt as possible, but about matching your leverage strategy to your overall goals. Second, your financing choices should align closely with your investment objectives to create a coherent plan that supports long-term success. And third, risk management is essential. Understanding the risks involved helps you avoid overextending yourself. Remember, the best financial structure isn't the most aggressive one. It's the one that the property can support and the investor can comfortably sustain. This balanced approach will help ensure both growth and stability.